Today, we're digging into a really fascinating analyst report that makes a pretty bold claim about Swiggy's future. And this isn't just about ordering food, you know? It's a deep dive into the company's two-part strategy that analysts think could be a complete game changer. So, what's their big idea? At the end of the day, any big financial report really just boils down to one simple question for an investor, right? Is this a good bet? Can you actually make money here? And that is exactly what this whole analysis is trying to figure out. And wow, the analysts do not hold back. Their conclusion is crystal clear. They see a huge opportunity here. They've put a firm buy rating on the company. But, why? Why are they so confident? Let's get to the numbers. Okay, so here it is. Their target price, 740 rupees per share. Now, that's a very specific, very bold call that's based on all their financial modeling. But a number by itself, well, it doesn't really tell you the whole story, does it? This is what that number really means. A potential 77% upside from the price when the report came out. That's not just a little bit of optimism, that is a massive vote of confidence. It's basically them saying they believe the market is seriously undervaluing Swiggy right now. So how on earth did they arrive at such a bullish conclusion? We're going to break it all down. First, we'll look at the analyst's big bet. Then we'll unpack Swiggy's two main businesses. After that, we'll see how they're forecasting future profits. And finally, we'll cover their final verdict and the risks involved. All right, first up, Swiggy's two business engines. The key to understanding this entire report is to just stop thinking of Swiggy as one single company. Instead, the analysts want you to see it as two separate but really powerful businesses working together under one roof. And this slide just lays it out perfectly. On one side, you've got food delivery. Think of it as the stable foundation. It's mature, it's already profitable, and it's chugging along, making money. But on the other side, you've got the rocket ship, Instamart. This is the quick commerce side of things, and it is all about explosive growth and massive future potential. So let's start with that foundation first. So let's dive into that first engine, the food delivery business. This is that profitable foundation we were talking about. It's the part of the company that pays the bills and, crucially, helps fund all the future growth. Now, before we get into the numbers, let's quickly clear up a term you're going to see a lot, gross order value, or GOV. It's simple. Just think of it as the total sticker price of everything ordered on the platform. It's the best way to measure the sheer size of the business. Okay, what's really interesting here is this growth rate. We're looking at 18.8% year-over-year growth. Now, for a business of this size, one that's already a market leader, that is a really healthy, sustainable number. It's not that crazy startup growth, but it's the steady, reliable kind of expansion you want to see. And here's the proof. In just one quarter, we're talking about a GOV of over 85 billion rupees for more than 17 million monthly users. But the most important number on this screen is that positive 2.8% margin. It means this engine is already profitable. It's actually making money. All right, now for part two, the engine that gets investors really fired up, Instamart, the high-speed growth engine. Just look at that difference. We go from a steady 18.8% for food delivery to a staggering 107.6% year-over-year growth for Instamart. This is that hyper-growth rocket ship we were just talking about. It's literally more than doubling in size every single year. So, is this rocket ship profitable? Well, not yet. And to really understand its journey, we need to look at something called adjusted EBITDA. It's basically a way to strip out certain expenses to get a clearer picture of the core health of the business and its path to profit. So the key thing to see here is the trend. Yeah, the margin is negative 12.1%, but the report points out that this is a huge improvement from negative 15.8% just one quarter before. So the losses are shrinking fast, even as the business is growing like crazy. And here is a fantastic little tidbit that shows this isn't just theory. According to the report, a full 25% of Instamart's dark stores, those are the little warehouses that pack your grocery orders, are already profitable on their own. This proves the model can work, and that it's possible to scale it profitably. And look, this isn't just some analysts being overly optimistic. The company's own management is aiming for a huge milestone, contribution break-even. That basically means each individual order will cover its own direct costs. They're telling the market they have a clear plan to get there by early 2027. So we have one engine that's already making money and another one that's getting better and better really fast. The billion-dollar question then is, when does the growth engine stop burning cash and start pushing the entire company into profit? The analysts lay out a very clear timeline. Fiscal year 25, still a big loss. But look at fiscal 26. They're projecting those losses get cut almost in half. And then fiscal year 27. That is what they are calling the big turning point. And wow, this slide shows that exact pivot in black and white, well, red and black. Just look at the EBITDA line. It goes from a loss of nearly 28 billion rupees in 25 to a projected profit of over 9.5 billion in 27. The net profit line tells the exact same story. This forecast right here, this is the absolute heart of their entire buy recommendation. Okay, so let's bring this all home and look at the final verdict. With this forecast in hand, why are the analysts so confident? And, just as important, what are the potential bumps in the road? So when you boil it all down, the argument is pretty simple, right? You've got the insane growth from Instamart. You've got a clear, data-driven path to overall profit. All of this is being supported by that stable, profitable food delivery business. And on top of all that, the losses in the growth engine are shrinking super fast. But of course, no investment is a sure thing. The report is clear about the risks. If people start having less money to spend, that could hurt growth. Any major external event could throw a wrench in the works. And finally, the food delivery world is, and always has been, fiercely competitive. These are the big things that could challenge this whole forecast. And so that really leaves us with the final question. The pieces are all there, right? A stable base, a high growth engine, a clear path to profitability. But at the end of the day, execution is everything. The big question is whether Swiggy can navigate those risks and actually turn this bold analyst forecast into reality. I guess only time will tell.